All right, so today I wanted to make a video about a company that I've never talked about before, Automatic Data Processing, ADP. This is a company that's been around for a long time. I believe it's in the Dividend Aristocrats list, so it's been around a long time. Again, professional services is the industry. Again, they provide outsourcing solutions specializing in cloud-based human capital management. Again, so they're going to do good when the economy is good. When you have a slowing economy, they're probably not going to do quite as good. But again, if you look at this company over the long run, they've always at least kept pace with or outperformed the S&P. I mean, they've easily beat it over the 10-year mark, the 5-year mark. They've beat it by a little bit as well. If we look at the 3-year, they beat it over the 3-year mark as well. So again, a company that always outperforms or beats the S&P. Again, like I say, they're a part of the Dividend Aristocrats list, I believe, at least the Dividend Kings. I believe it's at least 20 years they've been raising their dividend. Let's go back and, yeah, at least 20 years they've been raising their dividend every single year. I mean, if you go back 10 years, you have a, 8.7% yield on cost roughly. So again, very, very nice dividend growth. They're growing it very nicely. Again, they've already announced their next dividend, which is going to be up. Again, 2.42% yield. They're growing at 12.6% per year. Payout ratio is 66%. So the payout ratio is bordering on getting a little concerning. Again, if it goes above 80, that's when I would start to be a little concerned. But again, over the long run, they've always grown nicely. And I mean, the amount of people working over the long run, I would assume, is going to continue to go up. So I'm not super concerned. Let's look at the financials here. If we look at the balance sheet, this is something that's definitely a little bit concerning as well. The assets are only slightly more than the liabilities. Again, speaking on that, the profitability, again, they've always been very profitable. In fact, it looks like, at least based on operating cash flow and free cash flow margins, 2023 has been their most profitable years. Same goes for gross margin. So again, and operating margin, right? So again, this was their most profitable year they've ever had, which is exactly what you want to see out of a business, right? Let's look at the cash flow statement here. So again, if we look at the free cash flow, again, it's grown very, very nicely. Again, over the long run, it's just a fairly consistent stair step higher. 2023 was easily the highest they've ever been. If we look at the dividends, again, consistently going up over time. They've been buying back shares every single year going back at least a decade, which is nice to see. They took on a lot of debts in 2021, which is definitely concerning. Like I said, that balance sheet. Other than that, they haven't taken on a significant amount of debt since, what's that, 2016, right? So, again, that's something that probably is the most concerning to me, but it's not like it's crazy. It's not like it would cause me not to buy it, but it is definitely a little bit concerning. Again, current ratio of 0.98, right? Again, they are buying back shares. The intangibles aren't super concerning. They are growing nicely. They're very, very profitable, which is good to see. Management's doing a very good job. Return on invested capital, 71%. That's extremely impressive, right? Return on equity is 56%, right? Crazy good. The last thing let's get into here is the valuation, because again, valuation's king. When you're buying companies, you don't want to overpay, right? So let's look at the valuations here. If we go back 10 years, again, they've grown operating and free cash flow per year 11%, just over 11%. The compounded annual growth rate to the share price is only about 2.5%, which is also good to see. You don't want companies that the growth to the share price is coming from people simply paying a higher premium, right? That's not something you want to see, which is something you don't really see with this company, which is good to see. If we look at the average valuation, again, price of free cash flow, 31.69 is the average. The latest is 31.55. Price to operating cash flow, average 23.8, current 24.97. So ideally, you would get it a little bit cheaper, but again, it's basically right on its historical averages. Let's go back 5 years or so just to see. So again, 5-year average, it's actually below both of them. And not only that, the compounded annual growth to the share price has not grown at all, right? In fact, as far as free cash flow goes, it's actually gone down a little bit. and the actual growth to the free cash flow and the operating cash flow has grown almost exactly the same as the 10-year mark. So based on what I'm seeing, it's probably selling for about fair value where it's at right now. So again, if we see a dip in price, I would definitely look to pick it up. I'm buying extremely small percentages of it. Again, like I say, it's so important to keep an eye on valuations when it comes to buying companies, because you don't want to buy a company just because it's a good company, right? And you don't want to buy a company just because it's cheap. Those are mistakes that a lot of people make. Don't buy a company just because it's cheap. If it's a bad company, it's probably cheap for a good reason. And just because it's a good company doesn't mean you should buy it, because if you're paying way too high of a price, like, I mean, if this company had like a 40 price to free cash flow, I wouldn't even think about it. Or a 30 operating cash flow, I wouldn't even be thinking about it, right? So again, and it's very easy to figure this stuff out, right? It's very easy to figure this stuff out. So you have to keep an eye on it, and keep an eye on how they're growing, right? So again, those are the secrets that I have came across. That is my philosophy. Again, I'd love to hear other people's opinion on the topic. So please like, comment, subscribe, all that good stuff, and stay tuned for more.